Good afternoon, everybody. Welcome to today's OIC options webinar on options and the foundations of options pricing. My name is Mark Benzaquin, and I welcome you to join us today. Thank you so much. If you're in the Chicago area or anywhere in the Midwest, I'm sure you're experiencing this horrible weather as we are, so I hope you're in a warm place. Sit back and let's learn about some options. Before we begin, we're going to start with our standard disclaimer that options involve risks and are not suitable for everybody. For you beginners out there, if you're just thinking about getting into trading options, before you sign that options agreement with your broker, they're going to make sure that you've read and understood the characteristics and risks of standardized options. You could obtain a free copy from your broker or contact us at OIC and we'll be happy to get you a copy. Also, in order to keep things simple today, we're not going to be discussing costs to your trades, such as commissions, fees, margin, things like that. And the topics that we're going to discuss today are simply for educational purposes and are not meant as an endorsement or recommendation to trade. If you're unfamiliar with OIC, you should know that we are a free and unbiased group of options professionals, and we offer free options education. We do that mainly through our website, optionseducation.org, where we have a wide variety of online courses, podcasts, and videos, and our OIC webinar program. The pride of our OIC desk is that investor services resource that we have. You can reach us via email at options@theocc.com. You can also reach us on our website for live one-on-one chat. Please know that we do not make recommendations or provide advice. We're simply a sounding board for you to talk about options and provide education for you. That education, we feel, led to the increase in options volume, as you see here. The exchanges began back in 1973. The CBOE was the first to list call options only on about 16 different securities. And through the years, you can see the increase has steadily grown as it exploded in the early 2000s until last year. We cleared about a little over 5 billion option contracts on pace this year. We're at about 19 to 20 million option contracts a day. We feel some of that increase obviously was due to electronic trading, the advent of ETFs, but also self-directed trading. Option investors are taking more of an interest in their portfolios, and they're calling the shots and making their own decisions when it comes to trading options. And that trading occurs on the 5 primary markets that you see here. These 5 exchanges own and operate the 16 different option exchanges around the country. Those are the exchanges and the products that OCC serves, and the Options Industry Council, we are very, very happy to be a part of it. So let's go ahead and get right into our presentation. Here's our outline. We're going to start off with the basics. Option pricing basics. We're going to take a look at what's known as moneyness. For those of you that aren't familiar with moneyness, you're likely familiar with the terms that comprise that moneyness. That is in the money, at the money, and out of the money. So we're going to discuss what those terms mean. We're also going to look at what makes up an option price, the intrinsic versus the extrinsic value. And then we're going to wrap things up with a dive into one of the more popular Greeks, and I feel one of the more easily understood Greeks known as Theta. We also call it time decay. And we're also building in a very substantial Q&A portion of this session. So for those of you that have questions for us, and I see a few are coming in already, the bottom left-hand corner of your screen, there's a Q&A box that you can submit questions to our team. We've got Ken Keating and Bill Ryan from the Investor Services Desk. They're on the call right now, and they'll be answering your questions as we go along. They'll also be forwarding some of those questions to me as we do our Q&A portion later in the session. So be sure to ask the questions that you have. Feel free to shoot them off to us, and we'll get to as many as we can during today's presentation. So let's jump right into it with one of the questions that we're asked fairly often by beginners and presented to us here at the Investor Services Desk is who makes option prices, right? Where do these prices come? So when you're looking at your option chain, and when you're looking at your trading platform with your broker, you'll see the bid and ask market. So that bid price is going to be the price at which the market is willing to buy the contract, and the ask price or the offer price is the price at which the market is willing to sell that contract. But where do these prices come from? Are they just arbitrarily made, or is there some kind of method to that madness? So where the prices come from simply is from all market participants. All buyers and all sellers of that contract put forth their bid or put forth their offer, and that bid and offer is displayed to the markets as a whole. And those market participants can be individual investors or institutional investors. They're also professional market makers. So those professional market makers down there on the trading floor or up on the trading floors throughout the country, they put forth their best bid and their best ask or their best offer, and that's displayed to the industry. That best bid and offer is known as NBBO, or the National Best Bid, Best Offer Markets. And often when you put in a trade with your broker, he or she will route that order to the exchange that is currently displaying the best bid if you're a seller, or the best offer if you're a buyer. So who makes those option prices? You do. All market participants across the board, they're the ones that determine what they're willing to pay or what they're willing to offer or what they're willing to sell that contract for. But how much is it ultimately worth? Okay, if we've got a market of 3 bid at 310, what is that option worth? Well, it all depends on, I apologize, I advanced the slide here. It all depends on your pricing model. So that pricing model will tell you often what the value of that contract is going to be, but that value is simply a guideline. An option is ultimately worth what the market is willing to pay because it's a function of supply and demand. I can, for example, list my house with a realtor for $1 million, but if somebody's only willing to pay, say, $400,000, well, that's all that's worth, right? It's not worth $1 million. Just because I'm asking $1 million doesn't mean that it's worth that. In a couple of months, I'm sure we'll hear throughout all of the media when the Super Bowl is on the horizon that Super Bowl tickets are going for $10,000, $20,000, what have you. Well, they're not really going for that because people typically aren't paying those prices. So just because something is offered at a certain price doesn't mean that's what it's worth. It's worth what the market is willing to pay for it. And what the market is willing to pay for it is simply a function of supply and demand. Just like anything, when it comes to the options market and really any good or service, it's only worth what somebody's willing to pay for it, and that's a function of supply and demand. So one way to get a start as to what that option might be worth is to take a look on your trading platform. The trading platform will typically have an options calculator. We certainly have one here at OIC. And with the OIC calculator, for example, you can type in the symbol of a stock or a symbol of an ETF, and it will automatically self-populate with some information, and you can tweak that information. Or you can put in the information yourself. In this example, we've got a stock trading $100. We're choosing the strike price of 100 and assuming we've got about 49 days to expiration, volatility of 20%, and we put in the then going interest rate of just over 2%. The whole point of this is it calculates a theoretical value, and it bases that value on those inputs: stock price, strike price, days to expiration, volatility, interest rates, etc. And we're going to go ahead and look at that, take a little bit of a deeper dive a little bit later in today's session. But when we put in all of those inputs, it gives us the output, and in this case, the output being a theoretical value for the option. You can see that with those inputs, it tells us that the call option is worth just a little bit over $3, where the put option is worth just under about $2.80. It also computes for us, and I'm sure your trading platform does the same, it also computes for us what are known as Greeks. And you can see here we've got delta, gamma, theta, vega, and rho. We're not going to get into the Greeks today so much other than theta. We will be taking a deeper dive a little bit next week as we present a theoretical look at options pricing. But more importantly, in December, we've got our live in-person options presentation from Los Angeles. It's going to be simulcast around the country also, so you can listen to it online. And that three-part presentation is all going to be about the Greeks. So we're going to look at those in depth. For more information on that event, simply visit our website. But for now, what we want to know is what is that call option worth? What is that put option worth? And the point being is this is where we use a starting point. So for example, again, if we look at that option chain and it tells us the market is $3 at $3.10, we look at our calculator, it tells us that call option is worth roughly $3.06. That's a starting point. Chances are we're not going to get filled. If we're looking to buy the contract for just over $3, we're probably not going to get executed on that trade. If we were to bid, say, 305, 306, 307, something like that, then we may find a taker. Likewise, if we're looking to sell that contract, well, we may have a better chance of selling that contract at 307 or 308 than we would at 310. And we can also look at it and see that there's really no need to offer that contract possibly below 305 because of the value of it being 306 or so. We would have a little bit latitude in terms of our offer price. So what I want you to take away from this simply is that there are trading platforms out there that have options calculators that give you a good starting point of where to bid or where to offer that option contract. So moneyness, this is the concept that all beginner investors need to know. And again, it's in the money, out of the money, and at the money. Well, what exactly does that mean? If you are a beginner investor, you're learning about calls, you're learning about puts, buying and selling, rights versus obligations, etc. If we buy a call, we have the right to buy those shares of stock at the strike price. Now, do we want to buy those shares of stock theoretically above where the stock is trading or below where the stock is trading? If stock is trading $50, then I want to make the trade where I'm buying those shares for below $50. I want to buy them for 45 or I want to buy them for 40. So the fact that I can buy those shares cheaper than where it's trading, to me, makes that contract have inherent value. If I can buy the stock for $45 and it's trading $50, inherently that contract has at least $5 of value. And we'll look at that in just a second. But the point being is I want to buy stock below where it's trading. That's what we refer to as in the money. That contract is in the money for calls if our strike price is below our stock price. It's going to be at the money if our strike price is the same as the stock price. And it's known as out of the money if the strike price is above the stock price. Now, that doesn't necessarily mean that buying an out of the money call, for example, is a bad idea. You know, we can buy an out of the money 55 strike call, for example, when stock's trading 50. And the reason we might buy that is we might be extremely bullish on the stock. We think that stock's going to go to 60 or 70 or what have you. It's going to skyrocket. And we can buy that out of the money call on a speculation. We can typically buy it fairly cheaply. We might be able to buy it for, 50 cents or so. If the stock does take off as we expect, now that 50-cent call that we just bought might be worth $3 or $5 or $10. And in layman's terms, we hit it out of the park, right? We hit a home run. We bought an option for 50 cents. We turn around and sell it for $5, a tenfold increase in our investment. we'll take those trades all day. So it's not to say that out-of-the-money options don't have value. They certainly have their place in your trading portfolio if you are extremely bullish on a stock, or out-of-the-money puts if you're extremely bearish on a stock. But the point being is that ideally, we would want to buy those shares below where it's trading unless we have a very, very strong opinion that stock is going to increase in value. So when it comes to calls, we're in the money if it's below the stock price. We're at the money if our strike is the same as the stock price. And we're out of the money if our strike price is above that stock price. For puts, it's going to be the opposite. Puts, we want to sell those shares above where they're trading. So in the money puts is going to have a strike price above the stock price. At the money puts is going to be the same. If the strike price is 50 and the stock price is 50, it doesn't matter if we're talking calls or puts, they're both going to be at the money. And when it comes to out of the money on the puts, that's where our strike price is below the stock price. Again, we're going to sell shares, for example, at $45 when they're trading 50. If we go ahead and enact that trade, we're extremely bearish on the stock, and we think that come expiration, it's going to be trading below our strike price of, say, 45. Again, out of the money puts are going to be cheaper than in or at the money. And you might look at it as a speculative trade. Again, that's not to say that it doesn't have a place in your portfolio. It all depends on your forecast. And speaking of the forecast, I'm going to digress here for a second. When it comes to option trading, there's two questions that I say that an investor needs to ask himself. What is my forecast and what is my motivation for doing the trade? With the forecast is, where do I think the stock is going to go? How long is it going to take to get there? And then the motivation, why am I doing the trade? Am I being speculative? Am I looking for portfolio protection? Am I looking to generate income? Am I looking for leverage? Am I looking to buy shares below where they're currently trading? The point being, there's a whole myriad of reasons why option traders trade options. When you put it all together, it's simply flexibility, right? Options give us flexibility to accomplish any number of our investment goals in any number of different ways. But before enacting a trade, we always need to ask ourselves, why are we doing the trade and what are we expecting out of it? Where are those shares going to go? How long is it going to take to get there? And what's the purpose of doing a trade? So if we're looking at the-money options, whether it be calls or puts, we are extremely bullish or extremely bearish. That's our outlook, and possibly our motivation is simply speculative. We're looking to hit a home run with these trades, so to speak. So when we do these trades, we had mentioned out-of-the-money contracts cost less than in the money, for example. Well, that all simply means is that the premium that we pay or the premium that we receive as buyers or sellers is going to be greater or less than one another. So the premium is going to depend on our strike price. It's going to depend on stock price. And that's everything that we're talking about today, those option premiums. And we're going to get into just a moment as to what components go into that option premium. But the premium is something a buyer pays and something that a seller collects. Now, typically, the premium isn't lost in the sense of once a buyer pays that premium, it's gone out of their pocket forever, or once the seller collects the premium, they collect it and it's theirs to keep. That's not necessarily the case because as an option buyer, you can always sell that contract back to the market. As an option seller, you can always buy that option contract back from the market. As a matter of fact, when it comes to option selling, people say that it's smart to sell options because about 80% of option contracts always expire worthless. If you've been trading for or studying options for any period of time, I'm sure you've heard that comment, and that comment is it's a misunderstanding. The reason it's a misunderstanding is because about 72% roughly from the recent data that we have, a little over 70% of all option contracts never actually live to see expiration, meaning that they get bought or sold back into the market. If I buy an option for $1 and I can sell it back to the market a week later for $1.50, okay, I can go ahead and capture a 50% profit in my investment in just a short period of time and take all of my risk off the table. Anytime I'm buying an option, that premium that I pay represents my risk. So if I pay $1 for an option, that's going to be my risk. If I can sell that option back to the market for $1.50, well, I just made a 50-cent profit, and now that I sold the contract back and closed that contract out, my entire risk is gone. I'm out of the trade, I have no risk, and I've got a 50% profit in my pocket. And that's no different from option sellers. If I sell an option at $2, and 3 weeks later, a month later, what have you, I can buy that option contract back for $1, right? My risk is now gone. I've closed out that contract. I've pocketed the profit. I move on to the next trade. So the reason I say that statistic of 80% of all option contracts expire worthless, I say that it's misleading because 70% of all option contracts never live to see expiration. Out of that remaining 30%, a third of those, or actually 10% of the aggregate pie, 10% of those contracts actually do get exercised or get assigned. The balance, which is that 20% that everybody's talking about, those do expire worthless. So 20% of all option contracts technically expire worthless, about 10% actually get exercised, and the remaining 70% get closed out ahead of time. So just something to keep in mind if you're a buyer or a seller as to the fact that you can, in fact, close your contract out by buying or selling it back to the market. Now, back on the track of premium, it's quoted on a per-share basis. So typically, the option premium that you buy or sell represents 100 shares of stock. So if we're paying a $3 premium, it's actually representing $300 in the real world. So in the examples that I had mentioned previously, I buy a contract for $1, I'm actually going to see $100 debited from my trading account, not including commissions. If I sell a contract at $2, I would see $200 credited to my trading account, again, not including commissions. So I mentioned a little bit about that inherent value of the option contract. I want to buy stock below where it's trading, right? If I have a $50 stock and I buy a $45 call, for example, inherently that option is going to be worth $5 because theoretically I could exercise it. I could buy shares for $45 a piece. I could turn around and sell them to the market for $50 a piece. It gives me a $5 profit. That is what's known as the intrinsic value or the inherent value of the option. So if we have an in-the-money amount, that is going to be the intrinsic value of the contract. Now, any amount of that premium in excess of that intrinsic value, that's what's known as time value. If I buy an option for $3, and let's say I look at buying a $52 call with stock trading $54, right, that inherent value of the option is going to be $2, the difference between the stock price and the strike price. Now, if that option costs $3, I know that $2 of it is the inherent value. It's that in-the-money amount. Anything above that, that's going to be the extrinsic value. That's going to be the time value. And that time value is going to decay as time passes. So as each day ticks away, that extra $1 of time value, we're going to lose a little bit of that each and every day. And we're going to talk about that when we get to Theta in just a little bit. And the reason it decays is because at expiration, that option contract is worth only its intrinsic value. You can look at it as expiration as a binomial event. The option is either worth something or it's worth nothing. There's no in between. It's either worth its intrinsic value or it has no value whatsoever. Because when we exercise that contract, whether we exercise it early or if we exercise it at expiration, only the intrinsic value of the option is captured. Any time value, if we exercise it early, is going to be lost. If we exercise it at expiration, the time's run out, there is no time value left, so there will be no lost time value. It's only if we exercise our contracts early. So let's break down that intrinsic and extrinsic value in our premium pricing pyramid here. With our intrinsic value, that's going to be made up of the two components that we spoke of earlier, our stock price and our strike price. That gives us our intrinsic value. Everything above that amount is known as time value. And the components that go into time value, first and foremost, are time. How much time do we have between now and our expiration period? As that time is larger, say, now versus 2 years from now, it's the more time, the more money. Obviously, we've all heard the saying, time is money, and that's very, very appropriate and very apparent when it comes to options trading. And the reason is simple. This makes sense. If I'm an option seller and an investor comes to me and wants to buy an option that's expiring, say, this Friday, 2 days from now, well, I've got a pretty good idea of what my risk is going to be in terms of where that stock is going to be over the next 2 days. If somebody comes to me and wants to buy that same option contract, but the contract doesn't expire for another 2 years, well, I have no idea where that stock price is going to be over the course of the 2 years. So I'm going to be accepting a tremendous more amount of risk the further I go out in time, and because of that, I'm going to require additional premium to cover my risk. I'm going to demand a higher option price to compensate me for that risk. So the main value or the main component of that time value simply is time. The more time we have until expiration, typically the more expensive that option is going to be. Another component is volatility. Now, we're not talking the volatility of the stock per se. We're talking the implied volatility of the option. And implied volatility, again, it's a bit more of a complex option contract that we're not going to get into this presentation. There's certainly plenty of resources on our OIC website and our OIC YouTube channel dedicated to volatility. And next week's presentation, we're going to take a deeper dive as well. But the gist of implied volatility is simply a reflection of the market's expectation of the stock price as implied by the price of that option. So the higher the volatility of the option, the higher that extrinsic value of the contract is going to be as well. Lastly, the two components that also go into our time value is interest rates and dividends. Dividends, for example, is a time component or an extrinsic value component simply because if there's a dividend that the option pays, that's going to affect the option price. And buyers and sellers build in the cost of that dividend into the option price. If I'm a seller and I know I'm going to have to pay a dividend on this particular option contract because the stock is paying a dividend and now I'm at risk of being assigned and, say, deliver shares, well, then I'm going to require a higher option premium to be paid to me to compensate for that. Same thing with interest rates. If interest rates are high and I've got to borrow money to buy these option contracts, I'm going to expect to pay more for that contract simply because of higher interest rates. So our intrinsic value is simple. It's made up of the stock price and the strike price, both completely observable. We know what the stock price is. We know what the strike price is. Extrinsic or time value, it's a little bit more esoteric. We certainly know how much time between now and expiration. We know whether or not there's a dividend being paid. However, we don't really know where interest rates are going to be over the next 6 months or the next 2 years, let's say. And the implied volatility, that's certainly the wild card there, as we never know where volatility is going to go from one day to the next. So breaking it down a little further, here we go. Our in-the-money calls and puts, they will always have intrinsic value, and they may have time value depending on how deep that option contract is. But typically, in-the-money calls and puts always have time value. Always have intrinsic value, may have time value. Whereas the at-the-money calls and puts and the out-of-the-money calls and puts have no intrinsic value. The entire component of that option premium is made entirely up of time value. All right, let's look at an example now. We've got stock trading 53, and we're looking at the January 50 call, and we see a premium quoted of, say, maybe 515 at 525, and we look at purchasing that call for $5.20. With stock trading 53, and we've got a 50 strike call, we know inherently that that option is worth at least $3, right? Theoretically, we can buy shares for 50 and turn around and sell them at 53. So that's going to give us a $3 profit. So we know that out of that option price, $3 of that is going to be the in-the-money amount. Now, anything over and above that $3, that's going to be the time value. So our intrinsic value is $3. The time value then must be $2.20 because the total premium is simply intrinsic value plus time value. Or in this example here, we've got time value is simply the total premium minus the intrinsic value. If we know the intrinsic value is $3, we know that time value is going to be $3.20. But what if we had a 55 strike call? And again, assuming shares are 53, we're looking at a 55 strike call that's going to cost $2.10. What is the intrinsic value of that option, if any? And I'll give you a second just to take a look. So with that 55 strike call trading 210, that strike price is above the share price, so we know that there is no intrinsic value. That means that the entire option premium is simply going to be a function of the time value. So a 55 strike, $2.10 is the option premium, zero intrinsic value, the entire premium is time value. All right, and let's go ahead and take this a step further. Take a look at this. This is our premium value quiz, kind of a knowledge check. We've got 4 different scenarios. First scenario, stock is trading 77. We've got a $70 call trading $10.50. So the first question I have for you is that contract deemed in, at, or out of the money? Stock is trading 77, and we've got a $70 call. The strike is below our stock price. We're talking about call options, so we know that contract is going to be in the money. And the amount by which it's in the money, again, the difference between the share price and the strike price, that's going to be our intrinsic value, or $7. Anything beyond that $7 in the option price, that's going to be our time value. In this case, 3.5. So 77 stock, $70 call trading 10.5. It's an in-the-money contract, $7 worth of intrinsic value, $3.50 time value. Let's look at our next one. We've got 58.5 stock, a $60 put, trading $3.75. Is that contract in, at, or out of the money? $58.5 stock, $60 put, the strike price is above the share price, we're talking puts, that also is in the money. It's in the money by $1.50, and anything over and above that $1.50, that's going to be our time value. So this particular option trade, it's in the money with $1.50 worth of intrinsic value, two and a quarter of time or extrinsic value for the total premium amount of $375. The next option we have, $83 stock, $85 call, 2 1/4 premium. So what is is it in, at, or out of the money? That contract is out of the money, which means our intrinsic value is 0. So the entire option contract, the entire premium is time value. And when it comes to puts, when it comes to these calls, we've got $85 strike. That gives us the right to buy shares for $85. Stock is trading $83. So we can tell that that contract is out of the money by $2. We don't necessarily want to buy the stock trading $85 or for $85 when it's trading $83 in the market. And let's look at our last one here. Hopefully this should be easy for you. $12.50 stock, $12.50 call, $1.50 worth of premium. The stock price and the option price obviously are the same, so that tells us it's an at-the-money contract. And as we remember from the slides previous, at-the-money options have 0 intrinsic value. Their entire premium is time value. All right, I hope that was clear. I hope that made sense to everybody. If you had any issues with that, let us know in the Q&A. We'll be happy to cover it again, or simply visit our optionseducation.org website for additional information. So we had talked a little bit about the Greeks. I had promised you that we would cover theta, or time decay, and the reason we're doing so is because it definitely affects the premium of an option. So theta is going to be the option value's sensitivity to time. And simply what that means is that each day passes, the value of the contract is going to decrease by that theta amount. Again, if time, the days to expiration, is a component of our option price, as that time component decreases, we would expect the option price to decrease as well. So theta is the expected decrease in the value of the option with the passage of 1 day, not 1 business day, but 1 calendar day. And it obviously assumes all other factors constant. I apologize because I noticed a typo here. Represents cash amount per share. That actually should be represents cash amount per option. So if you're looking at these slides or taking notes, please make that change. And speaking of taking notes, in the upper right-hand corner of our presentation, you can download today's slides. So make sure you do so if you wish. And also this presentation, as with all of our OIC seminars that we do, the presentation is recorded, so you can go back and with these notes, go back and take a look at the presentation again. So again, theta, the decrease or the expected decrease in the option value with each day, and calls and puts have negative theta amounts. And what I mean by that is it doesn't matter if we're trading calls or puts. In almost all cases, that time value is going to eat away at the value of the option. An interesting thing to point out is that time decay is not constant. What I mean by that, if that theta is, say, 3 cents a day, so you're not going to lose 3 cents a day on that option each and every day that contract exists up until it expires and there is no time value. Time value accelerates as we approach expiration. As you can see by this graph, the time value declines steadily up until a certain point, and then the slope of that decay gets significantly sharper. Typically, that acceleration happens around 30 to 45 days out of expiration. That's where it accelerates, and for that reason, a lot of option sellers prefer to sell 30 to 45 day dated options. Option buyers may prefer to buy either shorter term options where there isn't that much time decay per contract, or significantly longer options where that theta decay is less pronounced. And we'll look at that in just a second, but the important thing to keep in mind here is that roughly 30 to 45 days out, that's where theta accelerates and really kicks in. And here we demonstrate that with a chart that shows a couple different option contracts. We've got stock trading 50. We're looking at the at-the-money call, so that's the 50 strike call. And the two examples simply differ in terms of implied volatility. The one on the left, we've got a 20% implied vol. The one on the right, a 40% implied vol. But let's look at the chart on the left. With a year out, the option premium is worth about $4. And each day, our theta is about half a penny. So 365 days out, due to time decay, that value of that contract, we're only going to lose about a half a penny worth of premium. If we cut that time in half and we're 150 days out, we're still losing less than a penny per day of option premium. Our premium went from almost $4 to about $2.50. So we're losing a substantial chunk, but again, we had about 6 months had gone by in terms of time decay, and we only lost about $1.40. As that time increases from 75 days out, 50 days out, etc., you see that time decay begin to increase from about a penny a day to 2 pennies a day, up until we near expiration, where it's almost a nickel a day. And that's where the option eventually will theoretically trade down or be valued down to zero at time of expiration. And that's the expiration day is the day at which theta is most pronounced, because theoretically that option contract is going for whatever it's worth down to zero, assuming it's out of the money. If the beginning of that option day, the contract is worth 20 cents, by the end of expiration, if it expires out of the money, it is going to be worth zero. So it goes from 20 cents down to zero. That's a 100% decline in value. And as you can see, the more volatile the contract, the more pronounced that theta is going to be. With our 40% implied volatility, we've got a year out to expiration. Now that theta is going to eat away about a penny a day of the option contract value, but you can also see that premium is double what it was previously. So that theta is going to accelerate greater the higher the implied volatility of the contract. It's still going to have that acceleration roughly 30 days out, 30 to 45 days out or so. Again, that's where option sellers like to capture the maximum time value that they have prior to that premium get eaten away. And when you think about it, it makes sense. If I'm selling an option for $2, ideally my end game is for that contract to expire worthless. So the quicker it decays in value, the better for me. Theoretically, I sell it for $2. A couple weeks later, if I can buy it back for $1, well, that's what I'm looking for. So I'm looking for that quick acceleration in decay of value in order to lock in some profits if possible. So that's going to be theta. Again, a deeper dive in theta as well as the other Greeks is going to occur in next month's live simulcast. So make sure you look, if you're interested in learning more about the Greeks, make sure you look at our website under the events section and register for those presentations that we have coming on the Greeks. So with all that being said, let's just kind of recap here what we've talked about today before we get into Q&A. The market prices, as we know, that's going to be determined by the buyers and sellers through supply and demand. So when you're trying to figure out where those option prices come from, supply and demand first and foremost. You can also use different pricing models. There's the Black-Scholes model out there. There's the Cox-Ross-Rubinstein model out there that give us different formulas to apply when determining the value of the option. Certainly in this day and age, really the easiest thing to do is go on the OIC website under our options calculator, or with your broker and their trading platform. They will provide to you some different tools for which you can determine that options value and use that as a starting point when you're bidding or offering your contract. The intrinsic value, that's going to be our inherent value, the in-the-money amount of the option contract. For calls, it's going to be in the money if the strike price is below the stock price. For puts, it's going to be in the money if the strike price is above the stock price. Everything else in terms of the option premium, that's going to be the extrinsic or time value of the contract. That's going to be the time till expiration, implied volatility, interest rates, dividends, etc. That time value is going to decay. That's the concept known as theta. That theta is going to eat away at the value of that option each and every day. And because of that, the passage of time works in favor of sellers and against option buyers. So that's what we have for today's presentation. If you're looking for more information, definitely visit our options education website, where you can download copies of our recorded podcast and videos, attend our live events, and register for our webinars. You can also visit our website or our investor services team, options@theocc.com. You can visit our YouTube channel where we've got archived presentations as well, and like us on our Facebook page, follow us on Twitter, etc., to keep apprised of future presentations. So let's go ahead and open this up to Q&A. Let's see a couple questions here. Here is a question from Jim. Jim is asking about out-of-the-money contracts. Why would I buy an out-of-the-money call when it has less likelihood or less probability of success? A great question, Jim, and you're absolutely right. Out-of-the-money options do have a greater probability of expiring out of the money, or a less likelihood of being profitable, in a sense, expiring in the money. One of the things to think about is expiring in the money and being profitable are two completely different things. If I've got a $50 stock and I buy an out-of-the-money call, 55 strike call, and I pay $2 for that option. So I've got the right to buy the stock for $55. For that right, I paid $2. So theoretically, in order for me to profit from this scenario, I need the stock to be at least $57. That's going to be my break-even point. So if the contract can be in the money, meaning stock can close at, say, 56, so now my $55 call is in the money by $1, but since I paid $2 for the contract, I actually lost $1 on the trade. So just because I'm in the money, it doesn't mean that I'm profitable. So getting back to your question, why would I buy an out-of-the-money call? Well, one reason might be you're extremely bullish on the contract. And as out-of-the-money calls or out-of-the-money contracts are typically significantly cheaper than in the money, you might be able to capture some profit based on based on that out-of-the-money strike. Assuming your forecast is correct, you bought this 55 strike call because you thought the stock was going to skyrocket. If it does, if you're right, and it goes to 60, let's say, or 65, and again, obviously these are just theoretical, arbitrary numbers that I'm just coming up with off the top of my head. But let's say stock goes to 60. You bought the 55 strike call, you paid $2 for it, and the stock goes to 60. Well, that call is now worth $5. You paid $2, it's worth $5, so you can turn around and sell it for a $3 profit. You paid $2 and you made $3, right? It's 150% return that you made on that option contract. Not a bad deal. That's a trade that I would make every day. Now, when you have out of the money calls, more likely instead of that contract being worth $2 or trading $2, you may actually only pay 50 cents. The problem is that you've got to go further in order for that trade to be profitable. That 55 strike call, like I said, trading $2, you need that option contract, you need that stock to go at least 57 in order to be profitable. Had you bought a 50 strike call when stock was trading $50 instead, maybe that contract costs you, say $5. Now you only need stock to get to 55 in order to be profitable. 55 is going to be your break-even point, as opposed to the out-of-the-money call, and 57 is your break-even. So in the money calls, when you look at it this way, greater probability, or I should say in the money contracts, greater probability of success in terms of being in the money, obviously, greater probability of turning a profit. You've got a lower break-even point, but you also have a larger upfront capital. You've got to pay that $500 upfront for the in-the-money call versus only $100 or $200 for the out-of-the-money call. In addition, the money that you pay upfront, that's your risk. So you're risking more than you would with the out-of-the-money call. But again, with options and with all investments, risks and rewards are something that you need to balance. Greater risk, greater reward. So definitely something to think about. So I hope that answered your question. Let's look at another one here. We've got Kevin asking about Theta, and again, how Theta affects that option price for buyers. Again, so the value or a component of that option contract is going to be time to expiration. So as those days decrease, naturally the value of that contract is going to decrease. If I've got an option contract worth $1, and every day that contract is going to decrease in value by, say, 2 cents, then theoretically 10 days from now, that option contract should be worth 20 cents less, or roughly 80 cents. I bought that contract for $1 and nothing else in the market changed. The stock remained flat, and now my contract is worth 20 cents less simply because of the passage of time. Well, that's something as a buyer I'm going to need to be concerned about. As a seller, well, that's exactly what I want, right? I sold the contract at $1, now it's worth only 80 cents. That's what I'm looking for. Theoretically, I could turn around and buy it back for 80 cents. I can pocket that 20 cent as profit. So that's why we say when it comes to time decay or theta, it works in favor of sellers and it goes against option buyers. Now, that's not to say that obviously we shouldn't buy options, because there's different ways to manage the position. Theta is one thing that would work against you as a buyer, but other things may work for you. For example, dividends we talked about. If I'm an option buyer, I have the right to purchase shares. If I'm a call buyer, let's say, and if I purchase those shares and they have a dividend attached to them, well, now I've got the right to buy dividend-paying stock. So as dividends increase, if a company comes out and they're going to now pay a dividend, well, that would likely increase the value of that contract. I'm going to be willing to pay more for that contract simply because that call option now comes with the right to buy dividend-paying stock. So again, I bought an option at $1. Company comes out and announces that they're going to pay a dividend. Now other investors are willing to pay more for that option. I can turn around and sell it for a profit. So whereas time value works against you, dividends may work in your favor. Implied volatility. As implied volatility increases, we would expect option prices to increase as well. So that's another thing that might, work in favor of options buyers. So, all is not lost when, talking about purchasing options. Time decay does certainly work against you, but there may be other factors that work for you. Let's see. Let's look at another question here. Asking about, it looks like Kendra is asking about the OIC options calculator and trading platforms in general. The OIC options calculator, as I had mentioned earlier, you can find it on our website. This is the information that it has for us. It gives us the Greeks, gives us the option value based on the inputs that we plug in. Now, your broker's trading platform obviously may be a little bit more robust. It may have additional bells and whistles. And when it comes to finding a broker, one of the questions we get asked a lot is, what should I look for when selecting an options broker or a trading platform? And that certainly is going to vary from investor to investor, what's important to you and what you're comfortable with. But the idea is that obviously you're going to want something that gives you option pricing. It's going to give you the Greeks, shows you implied volatility. You're going to want to see live option pricing or delayed quotes, such as we offer on our OIC website. And whether or not it's easy for you to understand. The thing that I like about our options calculator, it's very basic, very bare bones. It doesn't have all of the distracting bells and whistles, graphing capabilities, historical charting capabilities, etc. Some investors want that. Some investors need that. Others, it's not so important. So when it comes to looking for a broker or looking for a trading platform with various tools to use, it's certainly going to vary from person to person. So make sure that you vet a number of different platforms out there and see what makes the most sense to you. Let's see, we've got about 2.5 minutes left, and ladies and gentlemen, I need to apologize, but I'm fighting a cold, and my voice is just about giving out on me now. So what I would suggest you do is any further questions that you have for us, I do see a number of them coming in. Hopefully you will contact our investor services team with any further questions that you have. We will be addressing any questions that haven't been responded to already. We'll be responding to those tomorrow and the next day, so definitely keep an eye out in your inbox for those. Next week we've got Ken Keating from our investor services team. He's going to be looking at theoretical option pricing and talking about some of the more intermediate concepts, such as implied volatility, put-call parity, which is a concept that basically allows us to determine the price of one option from the stock price and another option, as well as synthetic trading, where we can put a couple options together to simulate long stock, long call, long put, what have you. And then he's going to be talking about a concept known as volatility skew. So definitely make sure that you tune in next week to that. And then lastly, our December option series, as we close out the year, we've got Dan Passarelli in the first week, I believe, of December. Dan is a third-party presenter with options mentoring services. Market Taker Mentoring is the name of his company, and Dan's a friend of OIC. always an engaging person and engaging presentations. So please join us for that. And then lastly, we're going to be closing up our fourth quarter options theme and closing out the live series presentations for the year as we visit LA for a live in-person session, all of which will be simulcast online. So make sure you visit our website for more details. If you're looking for downloads of today's slides, if any of you had trouble viewing the slides, make sure you download them via the download window in the upper right-hand corner. All of our presentations are in fact recorded, so you can simply join us and watch the replay via the confirmation link or the registration link that you used to join us today. Again, ladies and gentlemen, thank you for joining us. I hope you have a wonderful day and certainly wish you good fortune trading. Thank you.